Good morning, ladies and gentlemen, and welcome to the European Assets Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, I would like to submit the following poll, and I would now like to hand you over to Portfolio Manager Sam Kosh. Sam, good morning, sir.
Good morning and welcome everyone. Many thanks for joining us today. I'm joined by my co-manager Lucy Morris, and today we're going to be talking about European small caps, a area that over the long term has outperformed handsomely, but over the short term has been a bit of a challenge. But whenever you look through history at periods of underperformance of smaller companies, that has been the opportunity to buy for good, handsome, long-term returns. And we think we're at this stage now. So I'm just going to do a quick introduction of European Assets Trust before we move on to where small caps sit relative to history, and then talk about the companies, which for us is the really exciting thing. And within the small cap universe, we have some absolutely great niche global leaders. So let's just move through into European Assets Trust. Well, as I say, we're going to be talking about the European small dynamic market leaders, global, actually many of them global leading companies that happen to sit in Europe. And because they're in Europe, actually you can get them at discounts. And we think through time that leads to very good performance. I think it's a good opportunity to say also that we sit within the Columbia Threadneedle now, having been within Bank of Montreal, and within Columbia Threadneedle, we have a much greater resources and significant experience within the European smaller company space, and we can lean on greater research and idea generation within this company. And then a reminder: European Assets Trust. It's a collection of it's a concentrated portfolio of high quality smaller companies and the portfolio and the trust offers an attractive combination of growth through its exposure to smaller companies within Europe, but also high income. We pay out 6% of the year end NAV to shareholders, which means through time you get an attractive growth and attractive yield. So how do we do our investing? Well, quite simply, we look for high quality businesses that are run by management teams that are experienced and well incentivized, and we buy them at attractive prices, and that should lead over the long term to attractive total return for shareholders. To dig into this in a little bit more detail, a lot of people talk about quality, but we're very clear about what quality means. It's not just about sort of earnings upgrades, earnings growth. It's about strong business models that can deliver sustainably high cash returns on investment. So these business models need to be protected by what we call moats or competitive differentiation. And why is that? Well, it's so that competitors struggle to come in and compete high returns away. And in a stock market that assumes ultimately the returns get competed away, and the stock market is fairly myopic, companies that can consistently deliver supernormal profits are generally underpriced by the market, and we like to buy these high compounding businesses and hold them for as long as possible, quite frankly. Within smaller companies, it's important that they are run by management teams that are proven capital allocators, because we are going to be holding these businesses over the time frame that the capital is put to work and where we get the benefits of that capital allocation. But also our management teams that are rewarded for making the right decisions. So we like them to own equity in their businesses, but also the variable remuneration to be along the lines that we would expect. So based on things like return on invested capital rather than just earnings growth. So good businesses run by proven management teams that are well incentivized, and then we spend a lot of time understanding how these businesses are valued, and we want to buy great businesses at fair, attractive prices, and we generally use cash flow metrics to do that. Um, I've sort of alluded to the point about moats, the point that the fact that when businesses have moats, they are protected from competition, and it means that they can, over an extended period, deliver supernormal profits. And we allocate our portfolio to different sources of moats within the different sources of moats within the portfolio, as you can see. So, first mover advantage. Ken is a great example, a Irish house builder that's having a fantastic time this year. It was the first mover because during the fallout of the Irish housing crisis and the financial crisis, they were one of the few businesses that were able to take advantage of the very attractive prices of land at that point, and they built a substantial land bank that has allowed them to sort of be one of the only business, well, really the only land house builder of any scale within the Irish market, which is helping to deal with the housing crisis that's happening in Ireland at the moment. Intellectual property know-how, well, your patents protect you from competition. The intangible assets of investment through history allows you to invest ahead of competitors and maintain a competitive advantage. Carell, a company we saw yesterday, it makes controllers for HVAC and refrigeration units, and has a 45% market share, and is way ahead of its competitors there. Brand, well, Lucy's going to talk about Lotus biscuits, one of the highest quality smaller company growth stocks within Europe. So I won't steal her thunder there. And relationship switching costs. Well, Karnov's another company that we met last week. These provide information to legal information to lawyers. They again have about a 50% market share, and it's not worth lawyers moving to another competitor to get legal information, because it won't be as comprehensive, and it is key information for the lawyer to provide the service to its client. So moats are important for our investment process, and then growth as well. We want to have companies with wide moats that can grow consistently, and throughout our portfolio we are exposed to attractive growth, long-term growth themes, technical innovation. Well, I mean, the biggest theme there this year has been artificial intelligence, and through our semiconductor equipment stocks, we have been exposed to that. Health and wellness. Well, we've seen the hype over the weight loss drugs from Novo Nordisk and Eli Lilly. We're exposed to this through our pharmaceutical packaging company, Gerresheimer. Sustainability. Well, I've already mentioned Carell. When construction companies are trying to reduce their carbon footprint, they need better controllers for their ventilation systems, and Carell provides that. And in emerging market growth, well, we know that through time, emerging market demand is growing as middle classes consumption patterns start reaching mature markets, and we are exposed to that through things like Wizz Air, which is the Eastern European airline. So good businesses that have wide moats that can grow over a long period are the sorts of businesses we want to own, and we'll talk about that in further detail relatively shortly. But it leads to a portfolio with these characteristics. Yes, we are going to pay a bit more than the market, so the P is above the market level, and the EV/EBITDA dividend yield below, but we are more than compensated for that by the return on equities well above the market. The gearing in the portfolio is well below the benchmark's gearing, and when debt costs are increasing, that's important. Then the gross margin, operating margin are above the market too, and the earnings growth is above the market. So we are paying a bit of a premium to the benchmark, but we would say in absolute levels, very attractive valuation metrics, but we are getting more than compensated for that with the quality characteristics. I'm now going to pass over to Lucy, who will discuss the broader attractions of the European or the smaller companies and the returns that they can deliver over the long term.
Yeah, thanks very much, Sam. Yeah, so over the next couple of slides, we'll just focus on kind of the appeal of investing in smaller companies and show, exactly as Sam mentioned in his intro, that how through time they have delivered very powerful returns for investors. And really, the main reason they offer a better return is that they offer better growth. Through time, smaller companies grow faster than their large cap counterparts. This might sound obvious, but it gives investors exposure to the magic of compounding, where the continued growth of high returns can lead to a very powerful snowball effect in terms of those returns for investors. Another reason is the potential to be a beneficiary of M&A, so that's mergers and acquisitions. To be perfectly honest, it's not entirely clear whether companies doing the acquiring tend to benefit from doing those acquisitions in aggregate, and history is really littered with large companies making poor acquisitions which end up being pretty dilutive to their returns. However, the benefit is usually pretty clear for the shareholders of the smaller acquired company when they're bought out at a premium, that can range from 10 to 20 to 30%. So we'd say that growth and M&A are two clear themes where you get the benefit of investing in smaller companies. And then the next two underneath this are pretty interlinked: capital allocation and entrepreneurship. And Sam already touched on some of these points when he was talking about the types of companies that we like to own, but just to expand on them a little bit further. So with larger companies, it's often quite difficult for management teams to alter the direction of a business in short order with their capital allocation decisions. It's kind of akin to turning around a big oil tanker, where their scale makes change very slow to implement. With a small company, however, the decisions a management team make regarding the use of their cash flow and where to prioritize their investing can drive business change over a relatively short time frame. We, as investors, of course, have to be disciplined in terms of finding the managers who have a good experience of doing that and trust them to steer the business in a direction that we approve of, and that will help our investment over the holding period of us holding that stocks. And really, within small caps, you get access to some of Europe's best entrepreneurs, often who founded the company or the business is still being run by a family. So they tend to be very highly aligned with us as shareholders and have these proven track records of making those good capital allocation decisions. So in summary, when investing in smaller companies, you get better growth, you get the benefits of M&A, and you get to invest alongside some of the most dynamic management teams in the industry. And that isn't just the theory, as it's borne out in the share price returns, as you can see on this slide here. Whatever region you look at, over time, smaller companies have outperformed their larger counterparts. Yes, you get more volatility, they do tend to be more cyclical, and they do tend to correct more during market cycles. And obviously, unfortunately, last year wasn't evident of that. But typically, exactly as Sam mentioned, these corrections are periods you can take advantage of and reap the benefits over the longer term. So clearly, we're focused on European small caps, and Europe as a whole has been out of favour and shunned by a lot of investors over the last 2 decades, as there always seems to be something to worry about when considering the region. News flow over the time period on these slides covers the sovereign debt crisis in the early 2010s, it covers Brexit, it covers the pandemic and the lockdowns, and then obviously more recently, unfortunate scenarios of wars in both Ukraine and obviously the challenges in the Middle East. And obviously all of that is alongside pretty constant political upheaval, because you've got so many different sovereign nations within the European continent. But clearly from this slide, you can see in the top right-hand corner how good a place European small cap returns have been, or European small caps have been, to invest in that time, through returns significantly above any of the large cap regions in any of the other space, particularly relevant maybe comparing it to the US large cap, which has definitely been a bit of a darling over the last couple of years. So if we move on to the next slide, we'll see that there are a few particular reasons to pick out why investing in European small cap in particular is particularly appealing. As mentioned, Europe's been shunned due to that combination of war, the energy crisis, and the lack of these big technology stocks that have been dominating in the US. And the main outcome of this is the region is exceptionally cheap. For example, our index trades on a forward PE of around 12 times versus the US small cap market trading on over 18 times. And operationally, our businesses really have dealt with the current challenging times, and we believe the recovery potential of the market is high. Our universe for stock picking is extremely large, consisting of around 2,000 businesses across all sectors for us to research and potentially invest in when we find companies that match the quality criteria Sam highlighted earlier. And these companies are particularly under researched by the sell side community, and as such provide a greater opportunity to create alpha. In Europe, each stock in the large cap index is covered by an average of 24 analysts. And we look at the small cap index, that number falls to just 8. And even that coverage will be heavily skewed towards the upper end of the market cap range. So that gives us a chance to find stocks that are not well known by the market, and their potential growth or margin improvement isn't already priced in by the market, and we can invest before that gap is closed. As mentioned a couple of times already, the valuation picture for Europe remains very attractive. The downturn and derating last year has pushed Europe below its long-term median, and the region remains exceptionally cheap versus the rest of the world. In fact, that discount now is wider than it was during the global financial crisis and the Euro sovereign debt crisis, where there really was a real concern the Eurozone might break up and countries such as Greece teetered on the brink of bankruptcy. And as mentioned, investors really have been crowding in particular into US large cap as the AI theme dominates, and shying away from the more old-fashioned markets of Europe. But we really think this misses the high-quality, market-leading companies you can find within the region, some of which we'll go through in a bit more detail later on in this presentation. In fact, the price-to-earnings ratio discount of Europe versus the US is today at 35%, and that's almost the lowest on a record. And for us, that pitch, as I said, we're focused on European small cap, and that picture improves even further if we split Europe by market cap. Small caps remain attractively valued versus large caps, trading below their long run average. And we clearly believe that small caps represent far more dynamic, innovative companies with more appealing growth prospects, and that gap should close again. So with that, I'll hand back over to Sam.
Thank you very much, Lucy. So now I'm going to cover sort of shorter term performance and long term performance. I guess if we look at the 1 year figure, we've seen a nice recovery in the markets, and we're sort of broadly, I guess, in line with the benchmark, slightly behind. And what's driven that recovery? Well, clearly last year was tricky with aggressively rising interest rates driving a significant sell-off in the market, and particularly in growth stocks. And we sort of entered the year a bit more optimistic that inflation was under control and that the rate rises were sort of more or less behind us, but which helped the markets rally quite strongly in the first half of the year. But what we've seen, as you can see there, is the more tricky performance since the first half, with markets sort of weakening significantly. And the catalyst really for this was that the indications the Fed was going to actually keep rates higher and for longer. And this was really on the back of, while inflation was remaining sort of stubbornly high at the same time as the US job markets was still very robust, and simultaneously you saw a sort of uptick in bond issuance in the US, which sort of didn't help bond yields at all. So we saw the 10-year bond yield increase significantly over September, October, which drove markets down very aggressively, but also drove the sort of growth stocks, again a rotation away from growth stocks. And then, of course, you had the geopolitical risks with the Gaza war happening. So it's been quite a tough few months. Having said that, what we've seen this month is a much stronger recovery. Our markets are up roughly 9% this month, and we are ahead of that this month. So we are seeing a recovery start to happen. Why has that occurred? Well, Again, it's all about inflation. You've seen a sort of the inflation data, the CPI data coming in below expectations. That has meant that the market has started to price in peak rates. Central banks have done their job in raising rates, tightening the monetary environment, and the expectation now is that through next year, maybe towards the end of next year, you start getting a better rate environment. And you've seen the US bond yield go from about 4.9 to about 4.6. So that has been very supportive for markets. We would say, we don't know where the market's going to go over the next month, but we would, as Lucy has argued, when small caps have underperformed large caps, when they look very cheap versus large caps in the context of a region looks very, very cheap relative to the rest of the world, that has always proven to be the right time to be on the front foot with investing. And indeed, we have earlier in the month, at the end of last month, we started to gear the portfolio as idea generation was filtering into the portfolio. We've increased the number of names and we've increased gearing. So, over a year, performance roughly in line with the benchmark. More recently, a bit more challenging, but we are making that up over this month. And then, if we look at the long-term performance, we are still, in total return terms, since we managed the trust, started managing the trust ahead of the benchmark in terms of NAV and share price. And in response to a question on the Q&A, I can see, the 6%. We have managed to fund the 6% dividend yield and grow the NAV since we've managed the trust. Yeah, there have been periods where that hasn't been the case, but over the long term, we have managed to deliver a total growth in the NAV and deliver the 6% dividend yield and reduce the total expense ratio for investors. Admittedly, not through all times, but over the aggregate time in which we've been managing the portfolio. But let's now move on to really sort of the why we come in today and what we really look forward to as investors, and that's meeting the companies, finding these gems that sit within the large heterogeneous market that is the European smaller companies market. And Lucy and I are going to go through 3 global leaders in what they do that are not actually that well known. Well, certainly the ones I'm talking about are not that well known, yet are fantastic long-term growth stocks. And the first company I'm going to talk about is Engcon. Hopefully you can see the video we have here, which tries to explain what they do. But Engcon themselves are trying to change the world of digging. That is their mission statement. And this is a very small Swedish business that's family owned. They still are the controlling shareholders, that listed on the market the summer of last year. This company is the market leader in tilt rotators. What is a tilt rotator? Well, it sits between the excavator or digger arm and the bucket, and you can see in that video that tilt rotator allows the bucket to twist, or whatever tool you put on the end of the tilt rotator twist 360 degrees. Well, why is that relevant? Well, that is relevant because it massively increases the productivity of an excavator. That allows you to reduce fuel costs, reduce the amount of equipment you need, improve the safety outcome because the controller of the digger doesn't have to keep getting out of his carriage to attach a new tool to the end of the excavator arm. So actually the return on investment and the safety profile, the fuel saving on buying a tilt rotator, it is a very attractive equation and a very attractive prospect. Now, the Scandinavians have already cottoned onto this, and in fact, in Sweden and Finland, and to slightly lesser extent in Norway and Denmark, pretty much every excavator has a tilt rotator attached to them. But if you look outside that region, the penetration or attach rate is extremely low. So it's about between 3 and 5%. And that means you have a huge growth prospect if you can persuade people to use a tilt rotator. And the fact is, really, these things, once you actually get them in front of a construction company at a trade show, these things pretty much sell themselves. So what you're seeing is a company that's dominated its local region and is now branching out globally. And as the penetration goes from 3 to 5 to 10%, that's going to add multiple. I mean, the growth for a small Swedish company is going to be fantastic. So if we look at the UK, Germany, France, the Netherlands, and to a lesser extent in the US, you're starting to see them sort of reach a tipping point where this is a more accepted way of carrying out your building work. And in the US, it's making very attractive progress too, and that's through having relationships with some of the very big construction equipment companies such as John Deere, where if you went to the latest trade show that John Deere were presenting at, they on their machine they had a EngCon tilt rotator. In fact, this was on their electric product too. So so family owned, very attractive economics. So 25% operating margin, net cash on the balance sheet, a runway of growth that is, if the world gets anywhere near half of the penetration that you see in Scandinavia, the sales of this business will be multiple times higher than they are today, and they've got 45% market share, so they're the technology leader. So, referring back to what I was saying earlier, a strong moat and lots of growth and well incentivized management team. So a fantastic European small cap stock. And now I'll hand on to Lucy to our next interesting business within the space.
Yeah, thanks, Sam. So hopefully the Biscoff cookie here is one that you all recognise. And that brand was created by Lotus Bakeries in 1932 when the Boone family began baking speculoos, which are the decorative caramelized biscuits traditionally eaten on St. Nicholas Day, and delivering them door to door in their signature red truck in Belgium. Nearly 100 years later, we have a €6.5 billion company, and Biscoff is one of the top 10 cookie brands in the world. So whilst Biscoff is easily the most recognisable brand the company has, they actually own a number of different brands. So just first of all, about half their sales come from Biscoff, and that's delivered a historic average growth rate of 15% over the last decade. Close to 25% comes from their healthy natural food brands, many of which originated in the UK, such as Naked and Trek. And it also includes the popular kids snack options of Bear and Kidalicious. And they've grown at 16% per annum since they bought them in 2016. And then the remainder of their 20% of revenue stems from what they term local heroes, and that's shorter shelf life products popular in their home markets of primarily Belgium and the Netherlands. So there's significant growth drivers available. Apologies. There's significant growth drivers available for the globalization of the Biscoff brand. Part of this is geographic expansion, a bit along the same lines as EngCon, where they've got the chance to replicate the success of household penetration they have, for example, in the UK, where a pretty staggering 24% 4% of households will buy at least one Biscoff product during the year, into other large markets like the United States, where that penetration rate currently sits at only 5%. The company know how to do this, and they have a clever growth plan in place. For example, they start teaming up with airlines so customers can get used to the taste. They also work with influencers to get into popular recipes, as well as brands like Krispy Kreme, where you can buy a Biscoff donut at McDonald's, who put it in a McFlurry. All of this is to ensure that when the customer is in a supermarket looking at the biscuit aisle, they recognize the Biscoff brand. The second element they are focusing on is continuing to expand their product portfolio to offer more choice to consumers and ideally gain more share of their wallet. So after the biscuit, they initially created the spread that hopefully people are also aware of, and more recently they've expanded into a sandwich cookie along the lines of an Oreo, into ice cream, and most recently into chocolate. But as mentioned, they've also got other brands focused on healthy and natural snacks. And this segment offers a really good opportunity in a structurally growing, pretty disruptive market. So the trend from consumers has been towards more healthier snacks. And that's kind of really been the UK's been kind of leaders in there. And recent surveys have shown that 40% of consumers are willing to pay a premium for healthy snacks, and over 40% seek out snacks that provide energy or offer the ability to refuel. So they're growing at healthy snacks as a whole are growing around twice the rate of overall snacking. And Lotus is really well positioned. It's bought these leading UK brands back in 2016, and there's still room for them to grow in the UK. But they've actually got the chance to use their kind of great distribution network that they already have in place for the Biscoff to internationalize these brands. And they've already started that. They've taken them to across Europe. So this business has a lot of growth opportunities, but it also has very attractive underlying fundamental qualities. They have attractive profit margins of around 20%. They earn high returns. They've got a solid balance sheet, and they really are run by a very sensible, highly aligned, as I said, still the family are involved, management team. They've still got a 50% market share of the family. And as small caps, we've touched on it a couple of times, we really do like those family-run businesses as long as we're protected as minority shareholders, and that has been the case so far with this business. So in summary, we've got a business with large opportunities for growth. It's run by a sensible team. It earns high margins and it's high returns. And we really think it's protected by very strong barriers to entry. So in Lotus's case, it's its brand and its scale. We think that it makes far more of these speculoos biscuits than anybody else, and it'd be very hard for anybody to replicate their cost basis. And I really think, this is, as Sam mentioned when he was going through some of the types of moat, this really is one of the highest quality European small cap businesses with a lot of opportunities ahead of that. And I'll hand through back to Sam to go through one more of those.
Okay, so surgical science. In fact, we actually struggled to find a video that was appropriate to put here, because this company does software, simulation software for surgical applications. And as you can imagine, some of those videos were pretty gory. So, but again, this is consistent with the sort of the philosophy, the themes of what we've talked about. Again, this is a leader globally in what they do. They've got a far more comprehensive software offering covering all sorts of surgery. And again, this is a Scandinavian business. So this company sort of started off offering simulators and software to educational establishments for hospitals to help train surgeons for surgery. But the interesting thing here is that they've now moved towards selling their software to robotic assisted surgery companies. So what we're seeing is, again, similar to Engcon, the penetration of robotic surgery is very low. It's roughly 5% globally, although within the US we're talking more towards the 30%. But it is growing very quickly as people realize that robotic surgery reduces error rates, improves outcomes, and improves recoveries times. And quite frankly, surgeons prefer using robotic assisted surgery because it's a lot more comfortable there for them sitting in a booth rather than standing over a surgeon's table. And there is a problem with the aging of surgeons, so we need to keep surgeons going as long as possible. So ease of use but better outcomes is driving a greater demand for robotic assisted surgery. And what we've seen within that market is there's a company called Intuitive Surgical, where Surgical Science sell their software into, who sort of have driven the early adopters. But now we're seeing a number of other companies such as Stryker, Medtronic, CMR Medical, all introduce their suite of robotic assisted surgery devices into the market. And most of these devices, well, they're all clients of Surgical Science, but they will all have some Surgical Science software on to help train the surgeons when these robotic suites sit in the hospital. So there's a lot of growth. They're the market leader, but the economics of the business are also improving. Why is this? Well, their history is in the software and simulator. So, say a computer screen with the software on and some joysticks. But now they're moving towards a much more software model. So they're only selling their software to the robotic assisted surgery companies. Why is that interesting? Well, when you sell software, there's very little additional costs of selling it. So the gross margin is very high. So as robotic assisted surgery penetrates deeper into the market, Surgical Science mix of software will increase. That will improve the gross margin, the profit margin, and the cash generation of the business. So we think this company, and we don't think the valuation is very rich at all, because there's a huge runway of growth and the economics of the business are getting much better. So again, I mean, just to finish off on our company examples, another example of a small business listed in Europe that is a very strong market position and has a lot of growth ahead of it. So that is our presentation today. Hopefully, we've given you a good sort of run through of the sorts of businesses we're interested in. Um, uh, what drives long-term returns within the small cap market, and why we think now is the time to invest in European small caps if you're a long-term investor. And we'll leave it there and open it up to questions.
Perfect. Sam, Lucy, thank you very much indeed for your presentation this morning. If I may, I will just bring back up your cameras there. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Lucy, Sam, as you can see there in the Q&A tab, we have received a number of questions throughout your presentation this morning. And thank you to all of those on the call for taking the time to submit their questions. Peter, if I may now hand over to you, sir, just to chair the Q&A session with the team, and then I'll pick up from you at the end. Thank you.
Certainly. Thank you very much. And thank you everyone for joining us today. So just to start with the dividend policy, you have mentioned it a couple of times. The dividend policy is decided by the board. But the question specifically I'd like to ask you is how much of the dividend is generated by the portfolio on average?
Yeah, so when we would show the portfolio characteristics slide, you'll see that 2% of the dividend income in the portfolio, or the yield, is roughly 2%. I mean, we do get in the benchmarks about 3%. We do get capital coming back to us in other means. So share buybacks, for example, are very popular in Scandinavia because of the tax treatment. But so the capital return on the portfolio is just over 2%, I would say. So the rest does have to be funded from capital. The theory behind the 6% is, and this was decided way before we got involved in the trust, is that the long-term return on stock market should be roughly 6%. We should be able to outperform that, so we should be able to deliver a total return and a 6% yield and still grow the NAV, which since we've managed the trust, we've been able to do.
And maybe just to add to that, we like companies that have the discipline of paying dividends, but for us, as we've already alluded to, we think that we want companies that are run by great management teams that can put their capital to good use, and they should be growing faster than the market. So we'd rather that they, in many cases, put that capital to good use and generated further bigger returns for us into the future. So we don't go out particularly and look for high yielding companies. If the management team can put that to better use, that's great for us. And so it's not a question of we have a minimum yield requirement on the individual stocks that we hold.
It certainly makes the trust unique with that kind of yield income, being a small cap exposed fund. But Lucy, if I can stick with you, what's your current gearing position and what drives your decision around how much to gear?
Yeah, so as of today, we're kind of over 6% geared. That's about a bit of a change from more recent history. We've alluded to the fact that we think through time, and it's clear from the numbers, small companies offer the excellent potential for returns. So we should take advantage of that and be geared into those returns. And obviously, unfortunately, with the challenge of last year into a down market, and then kind of the markets coming off a bit into this year, that really is an opportunity for us to take advantage of the unique properties of investment trusts and increase our exposure to our portfolio and hopefully the recovery of returns from here. And as Sam mentioned, we've already seen some of that through November.
Thank you. Next question regarding market cap of your universe. How small is the question. Can you invest in stocks listed on AIM or European junior markets like BME Growth or Euronext Growth?
So we don't. I mean, we are continent. Well, we're Europe ex UK. So AIM is not where we're looking for. But yes, anywhere else in Europe we can. So we do have holdings on Euronext Growth. Small. I mean, look, we're not ruling out any stock. But I think typically, 500 millions are sort of. I wouldn't say that's the starting point, but that's roughly where we'll probably start looking, and we can go up to even 20 billion. And I think part of the point to make there is that when you think about European small and mid caps, it tends to be much larger than, say, a UK small and mid cap. I mean, actually, off the top of my head, I can't remember the average market cap, but it's roughly about 3 billion at the moment. So yeah, look, we can invest in the smaller indices within Europe, and we do have some investments there, but our average market cap's probably about the 3 billion level.
Thank you. A bit more specific now, are you exposed to any AI or GLP-1s? And you may have to describe what they are.
Yeah, so yeah, so AI is artificial intelligence, and GLP-1s as the sort of obesity drugs, which are sort of revolutionary obesity drugs. And you would have seen, many investors would have seen the Novo Nordisk's announcements and Novo Nordisk's share price performance, and Eli Lilly as well more recently. So on the latter, the obesity drugs, we can't invest in Novo Nordisk, it's too big, but we have exposure through pharmaceutical packaging companies that will help package these drugs when they hit the market. So one of our holdings that's done well this year is a German listed business called Gerresheimer, which is investing in production facilities to support the rollout of these drugs, which are, as I say, revolutionary. Artificial intelligence, well, that's probably the most. NVIDIA in the US, the announcements that they've had this year regarding the semiconductors that are related to that has helped drive that share price very strongly. But we do have within the portfolio a fair amount of exposure to similar themes. So one of the areas which we've invested in over quite a long time frame and augmented it this year with further further positions early in the year ahead of these announcements are the semiconductor equipment stocks, ASMI, which we've held for 15 years or so, and a stock we bought earlier this year called B Semiconductor. And these companies they're key to the semiconductor ecosystem that will drive the production of microchips for artificial intelligence. Which will feed into, for example, data centers, all sorts of applications, really. So we've seen those companies perform very, very well on the back of it. So we've got exposure to both areas. When we go back to when I mentioned our themes within the portfolio, digital transformation, AI is absolutely part of that. Health and well-being, again, GLP-1s, improving people's health is a key part of where we want to have exposure over the long term. So yes, we do have exposure there.
Lovely, thank you. And just passing back to Lucy again, a small question on gearing. What is the cost of the gearing currently?
Oh, I don't know if I have that actually directly to hand, Peter, but what we have a yearly facility that we arrange and pay a small margin over the base rate, and that comes up for renegotiation every year, but we can get back with the exact percentage.
Sure, okay, I'm sure that'll be fine. We've just done 45 minutes, so with that, we'll finish the Q&A and I'll pass back to Jake. Thank you.
Perfect. Peter, Sam, Lucy, thank you very much indeed for addressing all of those questions that came in from investors this morning. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish those responses on the platform. But Sam, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that would be great.
Sorry. Well, we welcome it. Thanks everyone for joining us today. Please send through any further questions to Peter Brown here, and we will be delighted to get back to you. But just to reiterate the point, we think European small caps are cheap and offer great long-term growth prospects, and periods of weakness have historically provided a great opportunity to buy, and we think we're at that period.
Perfect. That's great. Sam, Lucy, thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of the European Assets Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.